This video is for educational purposes only and should not be considered financial advice. Higher time frame mitigation blocks for more precise trading entries. In this video, we'll be going over how to use higher time frame mitigation blocks to get more precise trading entries. Outline. Intro. What is a mitigation block? Strategy. Examples. Recap. The mitigation block is characterized by a low, a high, and a lower low for a bullish mitigation block, and a high, a low, and a higher high for a bearish mitigation block. You are looking for price to respond to the lower low of the bullish mitigation block and the higher high of the bearish mitigation block. It's always best to draw out a line from the beginning of that candle where the mitigation block begins. So when you move to your lower time frames, you know exactly where you're trying to target. The strategy. On a higher time frame, draw out the closest mitigation blocks and look for price to reach into a mitigation block. Then move to a lower time frame to scope out an entry. It's best to go at least 2 time frames down to look for that entry. Here are some examples. We'll be going over a sequence of mitigation blocks during this 4-day time period. We'll also be using an hourly chart to look for our mitigation blocks, and then we'll move down to the 1-minute time frame. This is the Euro JPY. If we see here, you can recognize a high, a low, and a higher high. That creates a bearish mitigation block. Over here, you'll see a low, a high, and a lower low, and that creates a bullish mitigation block. We can also see how price responds to these mitigation blocks once it closes below. So we have price that moves down. It does not close below here. It does right here. And then when it comes back to it, that's when it responds. And that's where you want to take your entry and get that move to the downside. But as we see, this move to the downside actually creates another mitigation block, a bullish mitigation block that is responded to over here. Price went low, then high, then lower low, and then it moved above, and it came right back to this mitigation block. And we can see that recurring over and over again. This, of course, is another mitigation block. You have a low, a high, and a lower low that's created. But you also have a high, low, and a higher high that's created. I didn't mark that out, but we'll see how price comes in, and then you're looking for a move downward after this bearish mitigation block. So back-to-back bullish mitigation blocks and bearish mitigation blocks. So let's look at this one on a smaller time frame. We see how price came into this mitigation block, and this is a bearish mitigation block. We have our 1-hour line that we drew out. Price did not touch it here. It eventually touches it there. And now we're looking for our trade. And we see opposing liquidity over here. So price moves down and creates our level 2 entry. If you watch our other videos, you'll understand that this is the entry that we want to take because you have little resistance. Price usually moves quickly to the downside. So a level 2 is created. It moves to the 50% of that move and then rockets down to take out this liquidity. And that is our trade. And again, this is that move here. We see the bearish mitigation block. Price moved in, and then we took our trade. This is a bullish mitigation block, and we'll see this trade happen over here. So let's go to the smaller time frame. We see how price moved down into that mitigation block, and then it moved out. Now, if we look at our level 2 entry, that would have happened around here, or you can take it around here. But we have to pay attention to what's going on in context. Liquidity was taken over here. And we have to remember that there is also a bearish mitigation block that we're moving into. Let's look at that again. We see high, low, higher, high, and price is moving into that bearish mitigation block. So this is what will give us pause for our trade. However, if we look again on the smaller time frame, we want to try to go into at least 50% of this mitigation block. And so let's see what it looks like on the 1 minute chart. Again, we're shooting for this range. And so price dips back down and then comes back out of this mitigation block and gives us our level 2 entry. And that's also the great thing about level 2 is that you have a very tight stop loss. And so price moves out of the mitigation block. And since this is the close of the day, you might look to close at the end of the session. However, if you want, you can still keep some on because we haven't got to that 50% level of the mitigation block. And you'll see why that 50% level of a mitigation block is key. As we look here, this is what took place. During the change of session, price jumped and created a gap and actually overshot our 50% of that mitigation block. And it continued to the upside during the Asian session. So this was a very lucrative trade. Now, if you look at this mitigation block that was created, we have a low, a high, and a lower low. Once price closed outside of this mitigation block, we're looking for a trade to take it higher. And as you see, it did go a whole lot higher than we would have expected. And that's where you try to keep a partial so you can at least take advantage of some of these opportunities. So when price dips back into this gap that was created, a new day opening gap, you want to look for a trade to the upside. So let's go to the 1 minute chart. So this is that high that was created from the previous session. And we see how price dipped into that mitigation block. Now, when you look at taking a move outside of this mitigation block, we see a 1 and a 2 created. And then if you enter, you're expecting price to move higher. However, again, like the other trade, liquidity has already been taken, but even more so, there's a bearish mitigation block right here on a 1 minute chart. Now, 1 minute mitigation blocks aren't going to stop a moving train. However, if we take all of these things in context, we can see that there is some resistance to this price going higher. And again, if we realize that we're still inside of this bearish mitigation block, we need to respect the fact that price needs to reclaim this new day opening gap. So price moves to the downside. And then during the London session, it continues all the way down to that previous bearish mitigation block and creates our trade. We have a level 2 created right here. You have 1 and then 2. And then we have a retracement back into the 38 to 50% level. And then price moves out. And as we see, that was a very powerful move to the upside. Now, one thing to also note is that 50% of the mitigation block is a very key turning point. So you can actually start looking for your trade entries around that level. And as we see on this mitigation block, the 50% level is where price eventually goes to. Remember, this is our other trade we were watching, and it dipped down into 50% of this mitigation block. So the 50% level was respected here and here. And the 50% of this mitigation block was respected here. To recap, mitigation blocks are powerful tools for precise trading entries. By combining higher time frame analysis with lower time frame confirmation, you can significantly improve your trading accuracy. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more trading tips and strategies. Don't forget to hit the notification bell so you never miss an update. Until next time, happy trading.